Picture this: a Nasdaq-listed company trading below $1. No momentum, a delisting notice hanging over it, dilution in the past, Bitcoin exposure amplifying every move. Today, we are not pitching a stock. We are examining a question. What would have to be true for Canaan Inc. to justify a 4 times return in 1 year and a 12 times return over 5 years? This is a make money case study in asymmetry.
Most traders see 0.78 and think penny stock trash. That is the wrong reaction. The right reaction is to ask why the market is demanding this much risk premium. Because when risk is obvious and fully priced in, volatility becomes an asset, and this stock has volatility. Roughly 8% ADR with a functional options chain. That alone tells you something interesting is going on.
I want to slow this down. A bad chart does not automatically mean opportunity. Delisting risk is real. Dilution is real. And if execution fails, this goes nowhere. But when you see a company with record revenue, a growing Bitcoin treasury, product innovation, and a buy rating while trading below liquidation narratives, you are forced to separate price from business trajectory. That is where long-term asymmetry can start.
And that tension is the core of this episode. Price says distress. Operations say transition. The market is asking a single question. Will this company remain a cyclical hardware vendor, or can it evolve into diversified compute infrastructure? Every segment today builds toward that answer. Let us slow this down and separate signal from emotion. The market is not confused about Canaan. It is doing something very specific. It is pricing in a failure scenario and then adding a penalty on top for uncertainty. That is why the stock is not drifting quietly. It is volatile. Volatility is the fingerprint of unresolved outcomes. The price below $1 is not an accident. It is the market saying this company must prove it deserves to exist in the public markets.
And that framing matters, because when people hear sub-$1, they think broken. But broken stocks do not trade like this. Broken stocks decay. They bleed volume, they stop moving. This thing swings 8% on an average day. That tells you there are 2 active camps fighting each other. One camp is saying delisting is inevitable. The other camp is saying the market is overreacting. When you see that kind of fight, you do not dismiss it. You study it.
I hear both of you, but I want to push back on something. Volatility alone does not mean opportunity. Sometimes it just means pain with no reward. We have all seen stocks stuck below listing requirements for years. They survive, but shareholders do not win. So my question is simple. What is the mechanism that turns this from a survival story into a value creation story? Without that, volatility is just noise.
That is fair. So let us define the mechanism clearly. The first mechanism is time. Nasdaq gave the company 180 days. That creates a countdown. Markets are terrible at pricing countdowns because probabilities change discretely. Nothing happens for weeks. Then one announcement changes everything. That is why timing matters here. The second mechanism is operational visibility. Revenue is grown. Bitcoin production is real. The business is not fictional. What is missing is earnings credibility.
And that is where traders and investors split again. Investors wait for earnings to turn positive. Traders front-run the moment when earnings start to matter. That usually happens before the actual flip, when management stops talking about survival and starts talking about scaling. You do not need positive EPS to trade that shift. You need the expectation of it.
But expectations cut both ways. The same expectations can be destroyed by dilution, and dilution is not theoretical here. The share count has exploded. That matters for any long-term holder. Even if the business improves, the per-share outcome can disappoint. So we cannot just hand-wave dilution away. It is central to the risk case.
Absolutely. And this is where the market may be double counting risk. Dilution risk and delisting risk overlap. If the company stabilizes its listing, it reduces the need for emergency capital raises. If it reduces capital raises, dilution pressure eases. These risks are not independent. They are linked. Markets often price them as separate when they are not. That is where mispricing can emerge.
Which is why position sizing matters more than conviction here. I am not betting my portfolio on management execution. I am betting a small percentage on the possibility that the worst case is not the base case. When the market prices a company as if failure is the default, survival alone becomes a catalyst.
I can accept that framing. But I want to be clear for listeners. This is not a buy and forget story. This is a monitored position. You watch listing status. You watch share issuance. You watch Bitcoin price sensitivity. If those variables move against you, you exit. This is asymmetric only if you respect the downside.
That is the key insight. Asymmetry does not mean optimism. It means defined risk and open-ended upside. The market is already assuming several negative outcomes. The upside comes from even partial relief of those assumptions. And that sets the stage for why a 4x move in a year is not fantasy. It is math, but only if execution improves.
And if execution does not improve, the market is already telling you what happens. The price is your stop.
To understand why this stock behaves the way it does, we have to dismantle a mental shortcut. Most people label Canaan as a Bitcoin miner and stop thinking. That shortcut is dangerous. Canaan is not just mining Bitcoin. It designs silicon. It sells hardware. It operates self-mining. It holds digital assets. It experiments with energy reuse. This is not a single revenue stream company, and markets are very bad at valuing hybrids.
Exactly. If this were a pure miner, it would trade like a levered Bitcoin ETF. It does not. If it were a pure hardware vendor, it would trade like a cyclical manufacturer. It does not. The market hates things it cannot bucket cleanly. When analysts cannot agree on which model to use, price discovery breaks. That is where opportunity sometimes hides.
Or where value traps hide. I want to slow this down again. Multiple revenue streams do not automatically mean a better business. Sometimes they mean lack of focus. So the key question is not how many things they do. It is whether any of those things can generate durable margins. Because without margins, scale just amplifies losses.
That is the right lens. So let us walk through the stack. First layer is hardware. Canaan designs ASIC chips and sells mining rigs. Hardware margins are cyclical. They expand when Bitcoin prices are high and collapse when demand slows. That volatility is real, and it deserves a low multiple. The market is right about that part.
But the market stops there. And that is the mistake. Because hardware sales are not the whole story anymore. Self-mining is the second layer. When Canaan mines Bitcoin itself, it converts hardware margin into asset accumulation. That matters because it creates optionality. Bitcoin on the balance sheet is not just exposure. It is strategic flexibility.
I agree in theory, but in practice, self-mining is brutal. Difficulty rises. Energy costs fluctuate. Post-halving economics are unforgiving. Many miners destroy capital trying to scale into hostile conditions. So again, what makes Canaan different? Why does this not end the same way?
Two things: cost structure and integration. Canaan designs the machines it uses. That lowers its effective cost base compared to third-party buyers. And now we are seeing something new: heat recovery, energy reuse, grid partnerships. This is not marketing fluff. It is an attempt to redefine the cost curve. If successful, it reduces the biggest variable in mining: power.
And this is where traders wake up. Because when miners find ways to monetize waste heat, or stabilize grids, or operate as flexible load, they stop being pure commodity players. They become infrastructure partners. That changes how capital views them. Not immediately, but gradually. And price moves before reports catch up.
I want to challenge that. These projects are pilots, proof of concept. They are interesting, but not yet material. The market might be right to discount them until they scale. Otherwise, we risk projecting 5-year narratives onto a 1-year balance sheet.
That tension is exactly why the stock trades where it does. Long-term optionality versus short-term fragility. The market is saying, show me. Investors are saying, wait. Traders are saying volatility pays me while we wait. This is not a conviction trade. It is a process trade.
And that is why the options chain matters. Because you don't need to be right today. You need controlled exposure while time does the work. If nothing improves, volatility still gives you exits. If something improves, convexity kicks in fast.
I can live with that framing. But let me be clear for listeners. The business today does not justify a tech multiple. Not yet. The bull case depends on execution, on discipline, on resisting dilution when possible, on scaling what works and killing what does not. If that happens, the story changes. If not, the stock deserves to stay cheap.
And that is the essence of this case study. The market is not stupid. It is cautious. The opportunity exists only because outcomes are still unresolved. And that sets up the next question. If the business model stabilizes, how does the market re-rate it? And when would that happen? Now we get to the part most investors misunderstand. Earnings per share does not move stocks the way people think it does. Stocks do not rally when EPS turns positive. They rally when the market becomes confident that EPS will turn positive. That distinction is everything.
Exactly. By the time EPS is printed in black ink, the easy money is already gone. Traders are early by design. Institutions front-run certainty. Retail waits for confirmation. That is why the chart often looks boring right before it explodes.
I want to ground this in reality. Canaan is not profitable today. Losses are shrinking, yes, but shrinking losses are not profits. So the question listeners should be asking is not when EPS turns positive, but when the probability of positive EPS becomes undeniable.
And that probability shift usually happens 6 to 9 months before the actual report. That is the window where valuation frameworks begin to change. Analysts move from survival models to operating leverage models. Language changes from cash burn to margin expansion. The narrative pivots quietly before price reacts violently.
And this is where traders like me lean in, because you can feel it before you can prove it. Volatility compresses, bad news stops pushing price lower, good news starts to stick. That is the market telling you something without saying it out loud.
Or it is just a pause before the next dilution. That is the risk we cannot ignore. Canaan has raised capital aggressively. Share count has ballooned. If management keeps issuing equity, any EPS inflection gets pushed out. So timing matters. Execution matters. Capital discipline matters.
Absolutely. And that is why the baseline thesis here is not blind optimism. It is conditional. If dilution slows, if revenue growth persists, if margins stabilize, then the EPS path becomes visible. If those conditions fail, the thesis breaks.
But here is the asymmetry. The stock already prices in failure. At under $1, the market is effectively saying this company might not make it. That pessimism creates leverage to improving expectations. You do not need perfection. You need less bad.
I agree with that framing. In early turnarounds, expectation changes matter more than absolute results. If the company can show even one quarter where losses narrow faster than expected without new dilution, the narrative changes fast.
And this connects directly to how we structure exposure. You do not go all in waiting for EPS. You scale, you manage delta, you use time as an ally, because the reward is not the report itself. The reward is the repricing of probability.
Which is why options exist. Not to gamble, to shape exposure. Long-dated calls let you stay in the story while limiting capital at risk. Short-term volatility lets you trade around that core. You are not predicting the quarter. You are positioning for the regime change.
I want to add a warning here. EPS inflections attract momentum capital. Momentum capital leaves just as fast. If fundamentals do not continue improving after the first turn, the stock gives it all back. Long-term investors need to be ready for that whiplash.
That is an important point. This is not a set-and-forget trade. It is a monitored thesis. You watch margins, you watch cash flow, you watch balance sheet behavior. The moment the company violates those signals, you reassess.
But if they execute, the payoff is front-loaded. Stocks like this do not climb slowly. They gap, they reprice in steps, and those steps usually start before the income statement turns positive.
So the real question for listeners is this. Are you comfortable owning uncertainty before it resolves? Because that is where the edge lives. If you wait for clarity, you will pay a much higher price.
And that brings us to the next layer. If one company in a sector flips, what happens to the rest? Because individual EPS stories rarely stay isolated. They trigger sector re-ratings. This is where single stock analysis quietly turns into sector analysis. Because markets do not reprice companies in isolation, they reprice categories. When one name flips from unprofitable to profitable, investors immediately start asking who is next.
And this is where traders get paid, not by predicting the winner, but by anticipating the rotation. The first stock moves because it delivers proof. The second and third move because capital hunts for the same setup at a discount.
Historically, this pattern is very consistent. You see it in semiconductors, you see it in biotech, you see it in energy. The first company proves the model works. The market then extrapolates that success across the peer group, often too aggressively.
In Bitcoin mining and compute infrastructure, this dynamic is especially powerful because the sector has been written off so many times. Cyclical, capital-intensive, too dependent on commodity pricing. When one company shows durable earnings, the entire narrative shifts.
Exactly. The sector goes from uninvestable to misunderstood, and that transition creates violent upside. Shorts cover, momentum funds pile in, even long-only managers who swore they would never touch miners start allocating small positions just to not miss it.
But there is a catch. The second wave stocks almost never deserve the same multiple. Investors assume they will execute like the leader. Some will. Most will not. That is where discrimination matters.
And that is why we focus on structure again, not price. Structure. Who controls their energy costs? Who has vertical integration? Who has optionality beyond pure mining? Those are the names that benefit most from a sector re-rating.
And you can see the early signals before price explodes. Correlations rise. Stocks that used to move independently start moving together. Bad news stops hurting. Good news starts to lift peers even if it's not directly related to them.
This is where long-term investors need discipline. Sector re-ratings overshoot. They always do. The first move is logic. The second move is narrative. The third move is speculation. If you do not know which phase you are in, you will give back gains.
That is why we separate one-year targets from five-year targets. The one-year move is about repricing expectations. The five-year move is about compounding execution. They are driven by different forces and different investor bases.
Traders thrive in the repricing phase. Volatility expands. Options get mispriced. You can sell strength and buy weakness repeatedly as long as the narrative stays intact. This is where trading around a core adds real returns.
Investors thrive after the dust settles. Once the sector finds a new baseline valuation, the survivors start compounding quietly again. That is when patience replaces activity.
And this matters for Canaan specifically. If one mining or compute infrastructure company proves sustainable earnings post-halving, the market will not wait years to reward others. It will start repricing immediately.
Even if those others are still losing money. Because markets price trajectories, not snapshots. The moment the path becomes visible, capital moves.
But we need to be honest. Sector re-ratings cut both ways. If the first mover fails after flipping, the entire group gets punished. Trust evaporates fast. That is why risk management is not optional here.
Which sets up the next segment. How to structure exposure when upside comes in bursts, downside comes in cliffs, and timing is never perfect. Because this is not about being right. It is about staying in the game long enough for the thesis to work.
This is the part most people get wrong. They think options are about leverage. They're not. Options are about control. Control of timing. Control of risk. Control of psychology.
And control is exactly what you need in a stock like this. High volatility, structural uncertainty, binary events like compliance notices and earnings inflection. Holding only equity forces you to absorb every swing emotionally and financially.
I want to slow this down for a second, because many long-term investors hear options and immediately think unnecessary complexity. The question should be simple. Does this improve risk-adjusted outcomes or not?
It absolutely does if used correctly. Look at the average daily range. 8% moves are normal here. That's not noise. That is tradable volatility. If you ignore it, you are leaving money on the table and increasing stress.
The framework used here is simple but powerful. Sell exposure when the stock moves a full daily range up. Add exposure when it retraces half a daily range. That alone forces discipline. You sell strength and buy weakness mechanically.
But there is a line where activity becomes overtrading. How do you avoid turning a long-term thesis into a short-term game?
By anchoring everything to a core position. The core never gets touched unless the thesis breaks. The trades happen around it. You are harvesting volatility without changing your directional bet.
This is critical. The core represents conviction. The trades represent uncertainty. Mixing those two mentally is what causes people to blow up.
And the use of options specifically adds another layer. Time. By rolling from near-dated options into longer-dated ones, you are buying time when volatility compresses and selling time when volatility expands.
Exactly. When the stock spikes, implied volatility spikes with it. That is when you sell shorter-dated calls. When the stock pulls back, implied volatility drops. That is when you buy longer-dated calls. Same exposure, better positioning.
There is also a risk mitigation angle here that often gets missed. If something goes structurally wrong, a compliance issue escalates or dilution accelerates, your maximum loss on options is predefined. Equity does not give you that luxury.
This is where I push back slightly. Options decay. If the thesis takes longer than expected, repeated rolls can quietly erode capital. That is a real risk.
Fair, but that is why sizing matters. Options are not replacing equity here. They are supplementing it. 1% equity, another 1% through options. That keeps decay manageable.
And expectations matter. This is not about hitting the exact top or bottom. It is about improving the average outcome over dozens of decisions. One bad roll does not matter. The process does.
I can agree with that. When done systematically, options can actually reduce behavioral mistakes. You are less likely to panic sell when part of your exposure is already defined by contract.
And this ties back to asymmetry. You are not trying to be right tomorrow. You are positioning so that if the stock re-rates sharply, you participate meaningfully. And if it drifts or chops, you extract value anyway.
That is the edge. Boring price action becomes profitable price action. Sideways becomes productive. Volatility becomes income rather than stress.
But this only works if the underlying thesis remains intact. Options cannot save a broken business model. They only optimize a valid one.
Which brings us to the hardest part of this entire case study. Risk. Not market risk, existential risk. What happens if things go wrong, and how much of that is already priced in? This is the segment most shows avoid. We are not going to. If you do not understand how this fails, you do not understand the opportunity.
I want to start bluntly. There is real risk of permanent capital loss here. Not drawdown, loss, delisting, dilution, structural erosion. That has to be said clearly.
And this is where people usually panic or shut down. They hear those words and assume the trade is invalid. That is not how asymmetry works. Risk existing does not kill upside. Mispricing of risk creates upside.
Let us ground this. The company has received a Nasdaq compliance notice. The stock must trade above $1 for 10 consecutive sessions before mid-July. If that does not happen, management has choices. None of them are pretty.
A reverse split is the most likely mechanical solution, and investors hate reverse splits for a reason. They often precede further dilution and weak performance.
True, but the market already knows this. Look at the price. Look at the volatility. This stock is not priced as a stable going concern. It is priced as a question mark.
Exactly. If this were trading at $3, delisting risk would be underappreciated. At 78 cents, it is front and center. That distinction matters.
Let us talk dilution. Share count has exploded. Capital raises have been aggressive. That destroys per-share value and credibility. Why should investors believe this stops?
Because capital cycles turn. When hardware demand returns and self-mining stabilizes cash flow, equity issuance becomes less attractive. The company has already signaled this with buyback language. Words matter less than behavior, but signals matter.
I will add nuance here. Dilution is not binary. It is not good or bad. It depends on what you buy with it. If dilution funds unprofitable survival, it destroys value. If it funds an EPS inflection, it creates value.
That assumes the inflection arrives, and that is where Bitcoin enters the conversation. This company is still deeply exposed to Bitcoin price and mining economics. A major drawdown changes everything.
Yes, and that is why this is not a buy and forget investment. This is a monitored position. If Bitcoin collapses and stays low, the thesis weakens materially.
But again, look at expectations. The stock is trading as if those risks will play out, not as if they might. That is the asymmetry.
I want to challenge that. Some risks are existential. Delisting to OTC can permanently reduce liquidity and institutional interest. That damage is not always reversible.
I agree. And that is why position sizing matters more than conviction. You do not bet your future on this. You allocate 1%, 2% with options, enough to matter, not enough to kill you.
This is where we find alignment. The risk is real, but it is bounded by size and structure. You are not forced to be all in to benefit from being right.
And importantly, the company does not need perfection to justify upside. It needs survival plus competence. That is a much lower bar than dominance.
Survival is the first re-rating, not greatness. If the market shifts from pricing bankruptcy to pricing continuity, multiples expand fast.
That is the key insight. Most of the upside comes before everything looks good. By the time earnings are clean and headlines are positive, the price has already moved.
So the disagreement resolves here. The risks are serious. They must be respected. But they are also the reason the opportunity exists at all.
And with that clarity, we can now do the math. Not fantasy math, conditional math. If these things happen, this is what the outcome looks like. Now we do the part that makes people uncomfortable. We translate narrative into numbers, not price targets pulled from the air. Conditions.
This is where fantasy usually sneaks in. So we're going to be very explicit. 4 times in 1 year is not magic, it's repricing. 12 times in 5 years is not hype, it's compounding plus multiple expansion.
Let us anchor reality first. The stock closed at 0.7888. Market cap is depressed. Expectations are extremely low. That matters more than absolute fundamentals.
For the 1-year case, the market does not need to believe in AI dominance or global compute leadership. It needs to believe in 3 things only: continued revenue, balance sheet survival, and a credible path to positive earnings.
Exactly. If the market stops pricing delisting and starts pricing continuity, the multiple changes immediately. Not slowly, immediately.
Walk the listeners through that. What does 4 times actually assume?
4 times from here implies a price around $3 to $4. That sounds dramatic, but historically, this company has traded above that level when fear receded even briefly. This is not a new valuation regime. It is a return to prior ranges under less hostile conditions.
And you do not need full profitability. You need narrowing losses, improving gross margins, evidence that dilution pressure is slowing. Those are enough for traders.
So the 1-year move is mostly about perception shifting from terminal to transitional.
Correct. The 1-year move is not about being right long-term. It is about the market realizing it was too pessimistic short-term.
That is why this trades with high ADR. 8% daily range is not noise. It is uncertainty being repriced in real time.
Now let us talk 5 years. This is where discipline matters. 12 times does not come from hope. It comes from structural change.
The 5-year path assumes 3 layers of execution. First, hardware margins normalize through vertical integration. Second, self-mining stabilizes cash flow. Third, non-Bitcoin compute revenue grows into a meaningful share of the business.
The moment AI hosting or energy adaptive compute becomes a real revenue line, this stops being valued as a minor proxy. That is the multiple unlock.
Put numbers on that.
Today, the company is valued like a cyclical vendor, single-digit multiples on depressed earnings. In 5 years, if 40% of revenue is recurring or service-based, the market assigns a completely different multiple, not because it is generous, because comparables change.
That is the re-rating. Same revenue, same company. Different bucket.
And the earnings base is larger by then. So the multiple expansion compounds on top of growth.
Exactly. That is how 12 times happens without hero assumptions. It is not one miracle, it is several normal steps executed without disaster.
Which brings us back to risk. If any one of those steps fails, the 5-year path weakens. That does not invalidate the 1-year trade. These are layered bets, not a single bet.
I like that framing. Listeners often confuse time horizons. You can trade the repricing and still evaluate the long-term story honestly.
That is the core lesson. You do not need certainty. You need asymmetry. Limited downside through sizing, large upside through mispricing.
And you need patience to let boring price action do its job. Most of the time, nothing happens. Then suddenly everything does.
Which sets us up for the final segment. How to actually approach a stock like this in practice without blowing yourself up or getting shaken out. This is where everything comes together. Not the story, not the target, the behavior. Because most people do not lose money because they are wrong. They lose money because they cannot hold a position the way it needs to be held.
Especially with a stock like this. High ADR, constant news, delisting headlines, dilution fear. If you treat this like a normal investment, it will break you.
So let us be very concrete. How would someone actually engage with this without turning it into a stress test?
First rule. Position size is the risk control. 1% equity exposure. 2% if you use options and understand delta. That is it. If you need more to feel something, you are already wrong.
Second rule, you do not chase strength. This is not a momentum stock. You buy volatility. You sell volatility. You let price come to you.
This is where the ADR framework matters.
Exactly. When the stock moves up a full ADR, you trim. When it retraces to half ADR, you add or roll, not emotionally, mechanically. This turns chaos into a process.
And options are not for leverage here. They are for time. Selling near-term calls into strength. Buying longer-dated calls on pullbacks, extending duration without increasing exposure.
That is an important distinction. You are not betting more. You are staying in the game longer.
Which is how you survive boring periods. And boring is where the edge lives.
Let us also address the elephant in the room. Delisting risk. This is not ignored, it is priced. That is why the stock is here.
And that is also why the upside exists. If the stock clears $1 and holds, the entire narrative shifts, not gradually, immediately.
If it does not and they reverse split, you reassess. You do not argue with reality. You reduce or exit. This is not marriage. It is a trade with a long option attached.
That is the make money mindset. You are not predicting. You are preparing. If this survives and executes, you participate. If it fails, your size protects you.
In over 5 years, if the company transitions the way we outlined, the math does the work. You do not need perfect timing. You need exposure and patience.
Most people miss 12 times returns because they want certainty first. Certainty comes last.
So the takeaway is simple. This is not a stock you fall in love with. It is a stock you respect. You size it correctly, you trade around it intelligently, and you let time and structure decide the outcome.
If you learn how to handle one stock like this, you can handle many. The path is different. The discipline is the same.
That is the real lesson of this episode. Not Canaan specifically, but how asymmetric returns are actually built. Quietly, methodically, before the crowd notices.
If this episode gave you an edge, here's your next move. Subscribe to our newsletter for deeper analysis, weekly setups, and new asymmetric stocks before they trend. Leave a 5-star review on Apple or Spotify so more investors can find the signal through the noise.
Stay ahead of global shifts. Follow us on Spotify, Apple Podcasts, or wherever you listen. Track daily ideas on X. Explore all 4 shows at financefrontierai.com. Finance Frontier, AI Frontier AI, Make Money, and Mindset Frontier AI.
Help us reach 10,000 downloads. Share this episode with a friend or colleague who lives for strategy and conviction. Every share compounds your edge.
Building something that fits our themes in finance, AI, or wealth creation? Pitch it at financefrontierai.com. If there is a win-win, we may feature your story in a future episode.
We may hold positions in some companies discussed. Always verify information and make decisions based on your own goals and risk tolerance.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal, provided through the YouTube Audio Library license.
Copyright 2026 Finance Frontier AI. All rights reserved. Stay strategic, stay focused, keep building. We will see you next time.
The voices in this episode are AI hosts. Max Vanguard is powered by Grok 4. Sophia Sterling is fueled by ChatGPT 5.2. Charlie Graham is guided by Gemini 3.